Welcome back to the Deep Dive. Today, our mission is to cut through, well, just a ton of noise around Q3 2025 for Allient Inc.
Yeah.
That's ALNT.
Yeah.
They're a key player in precision motion and power systems. And if you follow this space, you know this stock had an absolutely massive run leading up to this earnings call.
That run is really the whole story here, isn't it? The context is everything. Allient came into this announcement up over 100% year to date.
100%.
So expectations were, just astronomically high. The results dropped after the close on Wednesday, November 5th, but the real action was the live call the next morning.
Right, at 10 a.m. Eastern, Thursday the 6th, just as the market opened and trading was in full swing. So you've got thousands of investors all trying to resize their positions in real time, waiting for management to justify a stock price that had, as you said, already doubled.
It was a pressure cooker environment, and it led to all the drama.
So let's start with the headline numbers. What did the company actually deliver?
Well, just looking at the numbers, it was an undeniable beat. I mean, across the board.
Okay.
Starting with the bottom line, adjusted EPS, it came in at 59 cents.
59. And the FactSet consensus was what, 49 cents?
49, exactly. So that's a 10-cent or roughly 20% beat.
Wow. A 20% beat on earnings is massive. And what about year-over-year growth?
It was soaring. Compared to last year's Q3, Allient's adjusted EPS jumped approximately 90%.
90.
They're showing just incredible operating leverage. And on the revenue side, the top line was strong too. They brought in $138.7 million.
Which beat the street's estimate of about $134.2 million.
Right, a solid 3.3% beat. Year over year, that's 11% revenue growth, and about 9% of that was pure organic growth.
So signs of a really healthy business that, in a normal world, should have been rewarded instantly by the market.
Exactly. Based on those fundamentals alone, you'd think the stock should trade up 5, maybe 8%. But that is absolutely not what happened.
And this is the fascinating disconnect we have to unpack for you. The minute the details started to sink in, the market, well, it panicked. The stock closed down about 5.6%.
And even that doesn't tell the full story. The intraday trading was genuinely shocking.
How bad was it?
We saw the stock trade as low as $44.30 at one point during that morning call.
$44?
Yeah.
From a close of over 53.
Yeah. Think about that. A steep, gut-wrenching fall of almost 17% before buyers finally stepped in to stabilize it. The volume was enormous.
So this wasn't just a slow trickle. This was large-scale profit-taking.
Totally. Just dramatic resizing in the face of what looked like confusing commentary.
Okay, so a clear financial beat meets a huge investor backlash. To understand the real story here, we have to get into the margins. Management's been pushing their efficiency plan. Simplified to accelerate NW. Is it actually working?
It absolutely is. The margins are the clearest proof. They achieved record high margins this quarter.
Record high.
Gross margin hit 33.3%. That's up a strong 190 basis points year over year.
Okay, that's impressive. And operating margin?
That climbed to 8.8%, which is a huge 350 basis point expansion from last year.
That kind of expansion, that's not just price hikes. That points to real, sustained internal changes, right?
It has to be. It's a combination of selling more high-value products and just rigorous cost discipline. They're scaling very efficiently.
What about EBITDA?
Adjusted EBITDA margin reached 14.6%. That's another 310 basis point expansion. And you can see the cost control, too. OPEX declined to just 24.5% of revenue.
But they're not done. They said they're on track for another $6 to $7 million in savings next year.
That's right, on top of the $10 million they already realized in 2024. This feels very structural, not cyclical.
Right. And that structural efficiency leads directly to the balance sheet. They're printing cash.
Exactly. And they're using that cash to dramatically clean up their debt.
So walk us through that deleveraging story.
It's robust. Year-to-date operating cash flow was $43.1 million. That's up 46% from last year.
Wow.
And they've used it to slash debt by nearly $34 million so far this year. So their net leverage ratio went from 3 times at the end of 24 down to a much healthier 2.1 times now.
Going from 3x to 2.1x in less than a year is a massive shift in their risk profile.
It really is.
I also want to touch on a strategic move they highlighted, the Dothan facility. This seems key to their future margin plans.
It is. The Dothan site is being converted into what they're calling a fabrication center of excellence.
What's the center of excellence?
Yeah, specializing in high-precision machining and additive manufacturing. So think, 3D printing for specialized industrial parts. They did note it caused some temporary inventory buildup this quarter.
So they're taking a short-term hit for a much more efficient future.
Precisely. The full benefits will start phasing in late next year, but the really substantial margin opportunities are expected to hit in 2026. This shows a management team looking way past the next quarter.
Okay, so if the margin and efficiency story is so strong, why did the street panic? We have to look at customer demand and the order books. That's where the tension was.
Right. So, and market performance was strong where it matters most for margins. Industrial revenue grew 20%.
That's almost half their business now, right?
48%, yeah. And the core driver here is their power quality solutions for data centers and HVAC. That's a huge secular growth engine right now.
Data centers.
Of course.
Especially with all the AI build out. So where did they hit the speed bump that spooked everyone?
It was in aerospace and defense, or A&D.
Yeah.
Revenue there only grew 2%.
Just 2.
And that was directly because of one specific program, the cancellation of the M10 Booker tank program by the U.S. Army.
Ah, okay. That's where the market's overreaction really started. Let's talk orders. Q3 orders were what, 133.1 million?
They were, which resulted in a book-to-bill ratio of 0.96.
So below 1. That immediately flags a risk. The market sees that and thinks future demand is softening.
And in a stock that's run that hard, a sub 1.0 ratio is immediate grounds for profit taking, regardless of the reason.
But management clarified this, didn't they?
They did. They were very quick to point out that if you back out the $5 million hit from that M10 tank cancellation, their book-to-bill would have been comfortably above 1.
So what looked like broad weakness was actually just noise from a one-time government contract cancellation.
A nuance that was completely lost on the quick traders and the algorithms.
It certainly seems that way. So what's the visibility like now?
Still strong. The total backlog is robust at $231 million. And they said the majority of that should convert to revenue in the next 3 to 9 months.
So good near-term confidence. What about longer-term growth, beyond data centers?
Well, they're pushing hard into higher value sectors like robotics, specialized aerospace, medical devices. But the one emerging opportunity they really highlighted was drone-related solutions.
Drones? Interesting.
Yeah, they see a lot of design activity there. They expect it to translate into significant revenue next year as these programs finish validation and move into production. That's a key future catalyst to keep an eye on.
It all sounds like a management team that's navigating a tricky environment really well.
Yeah.
But what did they flag as macro risks?
They pointed to the uneven global industrial environment, but the most acute risk, they noted, was ongoing constraints in components that use heavy, rare earth material.
Right, for their high-performance magnets and motion products.
Exactly. They said they're mitigating it by finding new suppliers and qualifying new materials, but it's a real operational constraint for them right now.
Did they quantify any of the other drags like tariffs?
They did. They mentioned a $385,000 net quarterly impact from tariffs in the power quality business that they just couldn't pass on through pricing.
So, legitimate headwinds. They're not just making excuses.
No, but they're not letting it derail the operational progress either.
Okay, let's put this all back into the investor context. Stock is up over 100% year to date. The narrative has shifted from a turnaround story to a compounding story.
And that shift makes for a very sensitive stock price. When you rally that hard, you've dramatically outpaced the broader industrial ETF, the XLI. The market just requires perfection.
Right.
So management is bullish on their structural gains, but the market seized on that sub-1 book-to-bill, despite the M10 explanation and the commentary on rare earths.
And that's what catalyzed the sharp profit taking. But what stands out to me is that the stock did stabilize. It found a floor around a key technical level, $48 and change.
Right, which suggests that longer-term holders and, some new buyers came in to defend that structural thesis. They were separating the temporary noise from any real fundamental weakness.
I agree. Okay, let's shift gears for our final segment. This is where we talk about high-conviction ideas, but remember, this is strictly for entertainment and discussion. Yes, we are not licensed to dispense investment advice.
Welcome to the Not Financial Advice segment. So we've established Allient is executing brilliantly on margins, deleveraging, and is tied into huge growth vectors like data centers and drones. Yet the stock got hammered.
Right, and that extreme divergence between great execution and a brutal market reaction, That presents an interesting opportunity.
It's really about relative strength, isn't it? The stock's run has been so company-specific, driven by internal changes, not just a rising industrial tide.
It suggests a decoupling from the general macro environment.
So what's the outrageous but plausible trade idea here?
The trade idea is a classic relative value trade. You go long ALNT and you short the XLI.
Long the company, short the sector.
Exactly. The thesis is simple. You're betting that Allient continues to generate alpha because of its own execution, the record margins, the deleveraging, and its specialized exposure to data centers and drones. And by shorting the XLI, you're hedging against that very same global macro risk that management themselves keeps flagging.
That's it. This trade profits if Allient simply stabilizes or rises modestly, as long as the broader industrial sector lags behind. You're basically using the trade structure to isolate and invest only in Allient's operational brilliance.
It's a very pointed way to express conviction while still acknowledging the risks in the sector.
It lets you focus on the things management can control, which this quarter proved they're controlling very, very effectively.
So what does this all mean for you, the listener? We saw a massive beat on the top and bottom line. Record margins, significant deleveraging. We saw the dual growth vectors of data centers and emerging drone tech.
And we saw temporary noise from the M10 tank cancellation and some supply chain issues. The fundamentals look strong. The market reaction was volatile, but arguably overdone.
Okay, so let's leave our listeners with one final thought.
The final provocative thought is this. If management successfully completes that Dothan transition into the Fabrication Center of Excellence and unlocks the substantial 2026 savings they've planned, how much higher can they structurally push that adjusted EBITDA margin beyond the current mid-teens level?
That really is the multi-year question, isn't it?
It is. That's what determines the stock's long-term trajectory from here.
The bar is set incredibly high, but Allient's execution continues to impress.
And once again, we have to stress, nothing we discussed here is investment advice. Always do your own thorough due diligence.
Thank you for joining us for this deep dive into the Allient Q3 call.
We appreciate you tuning in and staying well informed.